Hi, I'm Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nathaniel Ekman and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now, and finally, answer your questions. Please note that this presentation will be available on our website. That's www.valueline.com and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by the Value Line economics staff. The U.S. inflation outlook improved at the start of 2026. This was reflected in the January Consumer Price Index, better known as CPI report, which showed an easing in the pace of price growth at the consumer level. Specifically, the CPI and the core CPI, which excludes the food and energy components, increased by 0.2% and 0.3% respectively on a month-to-month basis. From a one-year perspective, the CPI and core CPI rose 2.4% and 2.5% respectively. The core CPI reading was at its lowest level since 2021 and suggests that thus far increased tariffs, even before the recent Supreme Court decision, are not having as big an impact on the price of goods as many economists feared. The market is expecting more than one interest rate reduction this year. The more benign January CPI report, along with lukewarm job growth over the last 12 months, may give the central bank more wiggle room to further cut the benchmark short-term interest rate. President Trump's appointee to lead the Federal Reserve, Kevin Warsh, would likely welcome such support for moves lower. But does the economy need a more stimulus from the central bank? After a weak start to 2025, the GDP advanced notably over the final 9 months of the year. And although the first reading on fourth quarter GDP revealed that output expanded by an estimated annualized rate of 1.4%, the figure was hurt by a full percentage point due to last fall's federal government shutdown. All in all, it was a decent quarter for the U.S. economy. The Fed will have to consider whether it wants to further stimulate an economy that will also receive fiscal support in the form of tax cuts, as well as regulation rollback from the One Big Beautiful Bill Act and administrative actions such as the Environmental Protection Administration's move to curtail emissions rules. In those circumstances, lower interest rates could risk a possible reacceleration in inflation. Meanwhile, fourth quarter earnings season has been a productive one for corporate America. With the majority of the S&P 500 companies having reported results, profit growth was averaging around 13%. If this continues to hold true, it would mark the fifth consecutive quarter of double-digit growth. Value Line concludes, in the current environment, we believe a diversified portfolio led by stocks of high-quality companies that have demonstrated a history of steady earnings growth and cash flow growth is warranted. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable resources. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation is that, in that regard, is the Value Line digital booklet, which offers subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital booklet, first head to the dashboard, where I am already located, then click on the investment survey under traditional online access. From there, the digital booklets for both the current and back issues can be accessed. Once the digital booklet is open, navigation is as easy as flipping the page or alternatively jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior member of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendation for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access these reports. First, head to the dashboard. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserve over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheet, Value Line has been reviewing and updating our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock's safety rank, an important tool to measure risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Now let's move on to the one stock to buy right now. For this, let's go first to our screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available but requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Today, we're going to be looking for reliable companies that balance strong year-ahead prospects with good return potential over the long run. We'll start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 highest to 5, with one including the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a safety rank of 2 or better. By applying that first criteria, we trimmed our potential candidates from 5,700 to 416. Now we're going to filter for timeliness. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is an easy to understand scale from 1 to 5, with those ranked 1 being the best performing issues on a relative basis. Most often, buyers will want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're going to be looking for stocks ranked 3 or better. After applying this filter, we are down to 235 candidates. We also want a stock that will generate solid returns over the longer term. To screen for these, we're looking for stocks with 3 to 5 year total return potential of at least 15%. Applying that filter, we are down to 85 candidates. We also want a company that will be able to grow its earnings at a double-digit rate in the coming year. So we're looking for EPS growth of at least 10%. After applying that filter, we are now down to 41 candidates. We also want to take a look at the top line. While earnings per share growth is important, sometimes that is driven largely by cost cutting, which has its limitations in some instances. We want to focus on companies with sales growth of at least 10% over the next year. By applying this screen, we chipped away our list of prospects down to our final 8 candidates. They are Boston Scientific, ticker BSX, Fujifilm Holdings, ticker FUJIY, Imperial Brands, ticker IMBBY, Harris Corp, ticker LHX, Microsoft, ticker MSFT, SEI Investments, ticker SEIC, Stryker, ticker SYK, and Zoetis, ticker ZTS. You make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one could be today's one stock to buy right now. And after consulting with a number of our senior analysts, we prefer and recommend Stryker Corp, ticker SYK. Before I click on Stryker, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top. Now let's click on the last full-page report on Stryker. Stryker is a leading global medical technology company that develops, manufactures, and markets innovative orthopedic, medical, and surgical, and neurotechnology and spine products to improve patient outcomes. As can be seen in the array, which is located roughly in the middle of our latest full-page report, the company has generated strong sales and earnings momentum in recent times, and we look for that trend to continue going forward. The company reported solid fourth quarter results for last year, which exceeded Wall Street's expectations. The company also gave a favorable outlook for this year, with sales and earnings likely to improve at a healthy rate. The overall number of surgical procedures incorporating Stryker's technology was expected to remain healthy over the next several months, while equipment spending by hospitals and health systems is poised to remain strong. The Michigan-based company should also benefit from favorable demographics, as there are some 70 million members of the baby boomer generation in the U.S., the youngest of whom are now in their early 60s. The graying of America augurs well for demand for many of the company's products, including knee and hip replacement, among others. While internal growth is likely to remain healthy, acquisitions ought to remain a key part of the company's long-term growth strategy. In fact, Stryker has made more than 50 acquisitions over the past decade. Strong cash flow and a healthy balance sheet ought to allow for more purchases down the road. Our 3 to 5 year target price range on the stock is $490 to $665. Our stop loss, which is the price at which we would plan to sell in the event of a price decline, is $288.02 based on yesterday's closing price. In summary, Stryker has strong earnings growth potential, which should lead to above average share price gain. It is today's one stock to buy right now. Before we go into our question and answer session, we'd like to note that we have sold our past one stock to buy right now recommendation, Netflix, ticker NFLX, as has hit our stop loss target. We will now tackle your questions. Please note we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few questions were submitted prior to the presentation. Now I'll hand it off to Nathaniel and Charlie.
Okay. Really quickly, before we move on to some more substantive questions, I've got one asking, with the relative strength graph that's found on the bottom right corner of the industry reports, like the ones that we saw in the digital booklet, how to read that. And that is measuring, the relative strength of that industry versus other industries in the value line universe for like the average timeliness of companies in the industry. So that is something that we measure. We rank industries. So you can track that.
Okay, this is Charlie. We had a question asked before the presentation. It was in regard to the P/E ratio and discussing it in more detail and how it can be a useful gauge for investing. The price-earnings ratio, the P/E ratio, or PE, is the most widely used statistic in investing. If you are like most accomplished investors, you will not make a move without knowing the PE ratios of the companies whose stocks are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic terms, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE by dividing a stock's current price by an earnings figure that includes 6 months of past earnings and 6 months of projected future earnings. For example, let us say a company's share price is $40 per share and its earnings per share is $2. Its PE ratio would be 20. That is $40 divided by $2. If the company's earnings jump to $2.50 and its price remains at $40 per share, then its PE would be lower to 16, a more attractive scenario in this case. There is no right or wrong PE ratio. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite is true for companies whose earnings are flat or growing slowly. If you believe that earnings are poised to take off before the market recognizes it, and the company is maintaining its current PE ratio, you might want to buy now in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if our analyst projects continuing growth for a company, but its P ratio is already high, you may want to wait for a pullback in price before committing funds so you do not pay more than you want based on the total return that you anticipate. You will also find a trailing PE and a 10-year median PE in our data. The trailing PE does not consider future earnings. It divides the stock's previous trading days closing price by the most recent 12 months of actual earnings. Our second question is, could you describe the timeliness ranking system in more detail? The Value Line Timeliness Rank measures predictive relative price performance of the approximately 1,700 stocks during the next 6 to 12 months on an easy-to-understand scale from 1, the highest, to 5, the lowest. Components of the timeliness rank include such items as a trend of relative earnings and prices and earnings surprises. All data are actual and known. A computer program combines these elements into a forecast of the price change of each stock relative to all of the approximately 1,700 stocks for the 6 to 12 months ahead. Subscribers should focus on companies that are ranked at least 3 or better for timeliness. We update timeliness ranks weekly, so investors should pay close attention to stocks they are interested in. And that's all that I had for prior questions. Nate?
The only other question I see is we have some questions asking if the stop losses that we've talked about appear on the regular value line pages, and no, those do not appear on the value line page. Those are things that we do in particular for these reports, because with the value line page, obviously there's a recent price that's printed, but that's fixed at a particular point in time. And so in terms of the stop loss, the right decision to make there is going to depend somewhat on when you bought in. Yes, so we don't have a stop loss printed on the actual page, because this is intended to be data to help you make an informed investment decision. And then we have other products where we actually provide stock selections, like we do for for these webinars. Like the Value Line Select is sort of a general stock picking service where we have one recommendation each month, and if that's something that appeals to you, you should check that out. And that does include a bit more information on past selections and the sort of general structure of the portfolio in that way. But the general value line pages do not include a stop loss, no. So if you want the stop loss that we talked about for today's selection, Alan, could you go ahead and repeat that for us so people can write that down if they want it?
I'm sorry, the stop loss?
Yeah, the stop loss for today.
Sure. The stop loss, well, this was based on yesterday's closing price. It would be $288.02 would be the amount of the stop loss based on yesterday's closing price.
Mm-hmm. Great, thanks, Alan.
You're welcome.
Beyond the page that we're displaying, is there some additional narrative in the report? Yeah, if you scroll down, you have our analyst comment there. Each page includes an analyst comment of roughly, it's generally about 320 to 350 words discussing the stock. And then, of course, we have the supplementary reports that we put out in addition to that if there's any pressing news.
Yeah, I would add that also in terms of the narrative in the report, you might want to read it in conjunction with the industry reports that precede each of the stocks, so you can have maybe a relative view of how the stock is performing relative to its peers within the industry. And these reports, as widely known, are issued once every 3 months. And as Nate said, there's also a supplementary report that is written if news breaks. The other question we had was regarding AI and helping Stryker to boost its profits. And it's said that Stryker is boosting profits by integrating AI into its robotic surgery, medical device, and hospital IT portfolio. to improve operational efficiency and enhance patient outcomes and address the labor shortages. They also had an acquisition in 2024 of care.ai, which accelerates this and is enabling AI-assisted virtual care and smart room technology that reduces costs for hospitals, that drives product demand. Some other ways to boost profits is through smart hospital and workflow automation. So by acquiring Care.ai, Stryker integrated ambient intelligence and AI-driven virtual care, and that allowed hospitals to reduce staff burnout and manage nursing shortages. This positions their smart room technology as a high-demand solution. They also have robotic-assisted surgery that is improved. AI helps with surgical precision and personalized orthopedic implants. They also have predictive analytics being helped by AI, or AI helping their predictive analytics abilities. They are moving from descriptive to more predictive, using machine learning to forecast patient outcomes and post-operative needs. And this helps customers optimize care settings and reduce overall costs. And finally, they have a more connected device ecosystem. So the integrated AI combined with the Vocera platform that they have allows for better and faster communication and workflow efficiency within the hospitals, and that increases the value of the medical device portfolio in general. Aside from that, I don't believe we have any other further questions. Nate, do you see anything?
No, I'm not seeing. Oh, actually, I am. Just dropped in. What was the fifth criterion we used in the selection today? That was 1 year sales growth of 10% or better. That was our fifth. But then other than that, I'm not seeing anything else that I think we can address right now.
Okay, thank you all for joining us.